Have you ever paused to consider a profound paradox in our modern financial world? Despite the global abandonment of the gold standard decades ago and the rise of sophisticated digital currencies, gold stubbornly remains a cornerstone asset on central bank balance sheets worldwide. Why does this ancient metal, no longer directly linked to our daily transactions, continue to hold such significant sway in the vaults of monetary authorities? This isn't just a historical curiosity. It's a critical insight into global economic stability, risk management, and the very nature of trust in our financial systems. A central bank's balance sheet is far more than a simple accounting ledger. It's a strategic declaration of its financial health and operational capacity. It meticulously details the assets held to underpin monetary policy, ensure financial stability, and project confidence in the national currency. These assets are crucial for managing liquidity, intervening in foreign exchange markets, and safeguarding against economic shocks. Typically, a central bank's assets comprise government bonds, foreign currencies, and various financial instruments designed to achieve specific policy objectives. These holdings are actively managed, reflecting dynamic economic conditions and policy priorities. However, gold occupies a distinct and often understated position among these diverse assets, setting it apart from its more liquid and policy-driven counterparts. One of gold's most compelling attributes, and a primary reason for its enduring presence, is its unique status as a non-liability asset. Unlike government bonds, which represent a promise of future repayment from a sovereign entity, or foreign currencies, whose value is intrinsically tied to the issuing government's economic health and political stability, gold carries no such counterparty risk. It is not dependent on the solvency or credibility of any single institution or nation. This fundamental independence makes gold structurally unique within a reserve portfolio. In a world increasingly interconnected and prone to sovereign debt crises or geopolitical tensions, an asset that is nobody's liability offers an unparalleled degree of security. For central banks, this means holding a portion of reserves that is immune to the default risk of other nations or the inflationary pressures of fiat currencies. Gold's neutrality is another powerful argument for its inclusion in central bank reserves. It is not beholden to the economic policies, political whims, or fiscal discipline of any particular country. This characteristic allows gold to serve as a truly global and apolitical asset, transcending national borders and ideological divides. Its value is not dictated by a single government's decisions or a specific economic bloc's performance. This inherent neutrality makes gold an invaluable stabilizing asset during periods of heightened global uncertainty or significant geopolitical transitions. When trust in traditional financial instruments or specific currencies wavers, gold often emerges as a universally accepted store of value. This historical role has been repeatedly validated through centuries of economic and political upheaval, reinforcing its perceived reliability. The presence of gold on central bank balance sheets also reflects a deep-seated historical continuity and a profound understanding of human psychology regarding value. For millennia, gold served as the ultimate monetary anchor, a tangible representation of wealth and stability. Even after the formal abandonment of the gold standard, the collective memory and ingrained trust in gold's intrinsic value did not simply vanish. Holding gold signals a recognition of this enduring historical legacy, providing a sense of continuity across evolving monetary systems. This signal can be particularly potent during times of financial stress, even if gold is not actively used in daily transactions. It reassures both domestic and international markets that the central bank maintains a prudent, long-term perspective on wealth preservation and monetary integrity. Central banks, as sophisticated financial institutions, employ rigorous risk management strategies to safeguard their vast reserve portfolios. Gold behaves distinctly from other conventional reserve assets like government bonds and foreign currencies. Its price movements often exhibit a low or even negative correlation with these assets, particularly during periods of market turmoil or economic downturns. This unique behavior makes gold an exceptionally effective diversification tool. By including gold, central banks can reduce the overall volatility of their reserve portfolios and enhance their resilience against unforeseen market shocks. It acts as a hedge against currency depreciation, inflation, and systemic financial risks, providing a crucial layer of protection that other assets cannot fully replicate. While central banks meticulously plan for various economic contingencies, they also prepare for rare, systemic events that could severely disrupt conventional financial markets. In such extreme scenarios, where payment systems might falter, credit markets seize up, or confidence in fiat currencies erodes, gold's role as a fundamental store of value becomes paramount. Its value does not depend on the functioning of digital networks or the solvency of financial intermediaries. Gold functions as a form of monetary insurance, a silent but intentional safeguard against tail risks. It represents a tangible, universally accepted asset that can retain value when other financial instruments might fail. This quiet, yet critical, role underscores its importance in a central bank's comprehensive strategy for national economic resilience. It is crucial to understand what gold does not do in the modern monetary system. Gold does not directly influence interest rate policy, nor does it fund government spending or circulate as everyday currency. Its role is fundamentally passive, not operational. It sits on balance sheets as a stabilizer and a store of value, rather than an active lever for monetary policy implementation. This distinction is vital for investors and economists alike. Gold's value lies in its inherent characteristics as a reserve asset, not in its utility as a tool for managing short-term economic fluctuations. It is a foundation of stability, not a dynamic instrument of economic intervention. The volume of gold reserves held by central banks varies significantly across nations, reflecting diverse historical experiences, geopolitical considerations, and economic structures. Some central banks, particularly in emerging markets, have been actively increasing their gold holdings in recent years, seeking to diversify away from dominant reserve currencies and enhance their financial autonomy. Others, with long-established reserve currencies, may hold relatively less. These differences offer valuable economic commentary on global financial trends. They highlight varying risk tolerances, strategic responses to currency volatility, and evolving perceptions of monetary sovereignty. There is no single global standard, but rather a spectrum of strategic choices driven by national economic objectives and geopolitical realities. For financial analysts and investors, understanding central bank gold holdings provides critical insights into global economic sentiment and potential market shifts. A sustained increase in central bank gold purchases can signal concerns about future inflation, currency stability, or geopolitical risks, influencing broader market perceptions. Conversely, a lack of interest might suggest confidence in existing monetary frameworks. This knowledge can inform investment strategies, particularly for those seeking to hedge against systemic risks or diversify their portfolios. It underscores gold's role as a barometer of global financial health and a strategic asset for institutional and individual investors alike. Ultimately, gold's continued presence on central bank balance sheets signals prudence, balance, and a profound respect for monetary history. It does not imply a distrust in modern fiat money or a desire to return to a gold standard. Rather, it signals an acute awareness that financial systems are dynamic, subject to evolution, and occasionally to severe stress. It is a quiet reminder that true stability often arises from a balanced approach, incorporating assets with diverse characteristics, rather than an over-reliance on any single tool or paradigm. Gold represents a timeless anchor in an ever-changing financial sea. Gold endures on central bank balance sheets not as a relic, but as a strategically vital asset. It provides unparalleled neutrality, robust diversification, and a deep historical continuity that underpins trust in an uncertain world. It is not a tool for daily monetary policy, but a fundamental safeguard against systemic risks and a testament to long-term financial prudence. Its role is a sophisticated blend of economic rationale, historical precedent, and psychological assurance, making it an indispensable component of global financial stability. In our next discussion, we will delve deeper into the intricate relationship between gold, silver, and the elusive concept of confidence in currency, exploring how trust fundamentally shapes modern monetary systems. Disclaimer: this content is for educational purposes only and should not be construed as financial or investment advice. Always consult with a qualified financial professional before making any investment decisions. If this analytical exploration of gold's role has enriched your understanding of global finance, please like this video and subscribe to our channel for more in-depth economic commentary and financial training. Your engagement inspires us to continue delivering valuable insights for investors, economists, students, and the general public. Share your thoughts in the comments below. We value your perspective. Thank you for watching, and we wish you a blessed day.